Good morning and happy Tuesday, everybody. Today is February 27th, 2024. The top story this morning, Bitcoin running like the blazes. Briefly touched 57,000 this morning while most of us were sleeping. It's come down a little bit off of those highs. Currently trading at 56,000 and change. Bitcoin has had a monster run ever since the initial dip after the announcement of that ETF approval or several ETF approvals. Ever since then, net flows into these ETFs as passive investors, people who just dump their money into the markets like we've seen in every other corner of the market. Some of that money is making its way into these Bitcoin ETFs, and those ETFs are buying the underlying asset in order to offset those shares that they're issuing. And so you've got a lot of buying of Bitcoin going on by these ETFs with their investors' cash. On top of that, you've got people I suspect are starting to front run that next halving. That's about 2 months away here, maybe a little less than 2 months. I don't know the exact date, but there's countdowns, there's tickers out there counting down the days. The halving cycle is when the payouts to Bitcoin miners gets cut in half, and thus there is less standard selling of Bitcoin because the Bitcoin miners are always selling their Bitcoin to pay their electric bills and their debt service costs. And well, when the halving happens, those miners have half as much Bitcoin coming in to sell, so it leads to less selling. Tends to put upward pressure on prices. And in the last few halving cycles, that has triggered FOMO rallies as people just piled into Bitcoin relentlessly, sending the price up several X. Now, we don't know if that's going to happen again with this halving cycle. The last few halving cycles, they've all made these monster runs, but we've seen smaller and smaller reactions of the market to the halving cycles, still monster reactions. But that one is coming up in the not too distant future. Also going on this morning, Lowe's just reported earnings, and while the headline may be saying Lowe's beats earnings expectations, which everybody beats earnings expectations, that doesn't matter anymore because analysts are just cheerleaders for stocks, and they lower their expectations to make sure that no matter how bad things get, no matter what they report, it's a beat. But within that beat from Lowe's was a monster figure. Same-store sales down 6.2%. At Lowe's in the U.S. Now, keep in mind, guys, we've still got 3.5% inflation, so you can take another 3.5% on top of that. That means you've got about 9% and change less stuff walking out the door at the average Lowe's store in the United States. And what's going on there? Well, that is the frozen housing market. Existing home sales are at the lowest point they've been since the GFC. They might even be lower as far as the number of homes that are actually selling right now. I haven't looked at that chart in a couple of days, so I don't know exactly where it's at. But the housing market is frozen, and because people aren't buying and selling houses, people aren't going to Lowe's. They're not fixing up the bathroom. They're not buying a few extra gallons of paint to change the color in that one room. They're not doing the big landscaping project on their new house. It's just frozen in place, and so DIY is taking a big hit. And Lowe's is seeing a big hit from that. And that's also after Home Depot reported earnings that were pretty bad last week. So the housing market is starting to show up in retail here, at least in specific sectors. Japan inflation is at 2%. That was a little bit higher than expected. So we've got some of the Japan bulls are out there. I don't know if bulls is the word. Some of the Japan rate hike bulls are out there saying that this increases the odds that the Bank of Japan comes off of its zero interest rate policy or its negative interest rate policy sooner. And check out these next few headlines in a row. These are bad this morning. Macy's is closing 150 stores. Now, Macy's only operates 489 stores, so it's about a third of all the Macy's in the country are closing. Now, what's going on here? This is a real estate story. All right, for years, the writing has been on the wall. Macy's business model is done. All right. The big anchor store at the mall. Malls are just these ghost towns with tumbleweeds in the parking lot that we drive by and reminisce about the 80s when we used to look forward to going to the mall. And now we laugh about how that never happens. Well, Macy's is still there trying to do business. Macy's has been a real estate company for the last 10, 15 years. The company is not valued based on what its stores earn. The company is valued based on the value of the dirt underneath the store. It's real estate that it owns. And well, that real estate is in trouble. Commercial real estate is obviously in a bubble. We're watching that bubble burst in real time. So Macy's is deciding we can't sit on this anymore. It's time to shut down these stores and sell the dirt that they're sitting on. And so this is a big move in real estate. Macy's shutting down 150 stores this morning, or announcing the shutdown of 150 stores. We don't know how many employees this is going to impact, but it's a good bet it's going to be in the thousands. Macy's also mentioned that they're opening up a couple of their higher-end retail stores, but it was low double digits, nowhere near offsetting the 150 that they're closing. We also got layoffs at Sony, just announced a few minutes ago. Shout out to my moderator, Mish, who caught that one almost in real time. 900 people are getting laid off at Sony's interactive segment. That's their video gaming segment, or about 8% of the workforce. And guys, that's telling, because it's another one of those semiconductor stories. Hidden within NVIDIA's earnings recently has been a lot of talk about, hey, their gaming segment was good. And NVIDIA's most recent numbers, I think their gaming revenue increased by 50% in the most recent quarter. I think that was the year-over-year number. Well, Sony's laying people off in video games. So how is NVIDIA's gaming segment doing so well if the people who make video games are cutting headcount? Not sure these two stories are in perfect agreement with each other. Shout out to Kakashi on X, who has been doing some great research and recently pointed out that it really looks like RTX 4090 GPUs that are traditionally sold for gaming PCs might be getting sold to China in order to string them together into a data center and try to run AI on them because of the chip embargo. And therefore, NVIDIA is actually reporting AI revenue as gaming revenue, which would be somewhat misleading in their reporting. And that's also something that NVIDIA previously got slapped by the SEC for doing in 2018 when they were reporting sales of GPUs to Ethereum miners as gaming revenue, even though it wasn't gaming revenue. And so they were misleading their investors about how exposed to cryptocurrency they really were. It looks like that might be actually happening again. And that the story about Sony laying people off this morning is somewhat supportive of that. And we also had a massive cyber attack a few days ago in the U.S. I don't know how I missed this one in the live stream yesterday, but a division of United Healthcare was hacked, and it affected pharmacies all over the country. That's a big one, and it didn't get too much press. It seems like it's one of those stories that they're like, yeah, we'll just sweep that one under the rug. No need to look at the fact that people are having trouble getting medicine because of a cyber attack from a state actor. That was interesting. Scary stuff going on in the world today, guys. With that being said, why don't we shrink my big melon of a head and let's see what's going on in the markets this morning. And guys, don't forget that like button while we're doing that. And if you're new to the channel, hit that subscribe button and have your coffee with the melon heads every morning. Also, don't forget that notification bell that's right next to it. Looking at the S&P this morning, we are up just barely 5 points in the black, 0.1% higher for the S&P 500. The Dow, though, not doing quite as well, down 21 points or about 0.06% to the downside. Not a huge downside move, but a little bit. And the NASDAQ is leading the way higher, up 41 points this morning, or about 0.25% to the upside. We've got a slightly weaker U.S. dollar this morning. The U.S. dollar index, or the DXY, is at 103.76. That is down 7 basis points this morning. And looking over at the the yield curve, my head is a mess this morning. We have got the longer end of the curve is lower and a little bit of green. On the short end of the curve, the 30-year Treasury is at 4.413. That is down about 0.5 basis point. The 10-year is at 4.288, down 1 point. The 2-year, 4.693, that's down 2 points. And the 1 month is unchanged at 5.400. Looking at commodities, we've got April gold futures at $2,044. That's up $5 this morning, about 1/4%. May silver futures at $22.88, up 15 cents, or 0.66% higher. Platinum is up just under 2%. Palladium is pretty much unchanged. April crude oil futures for West Texas Intermediate at $78.08. That's up 50 cents this morning, or about 0.66% higher. Check out this chart of Bitcoin, guys. Bitcoin is running like the blazes here. Look at this. This is the start of another FOMO rally, it looks like, guys. This thing's about to go vertical, and the halving hasn't even happened yet. Now, this is a little bit different, and not to use the cliche of it's different this time, but the last few halvings, this big parabolic move, it didn't start until after the halving, several months after the halving. It doesn't usually front run. So I don't know if this means we're just getting it done early this time. The ETF story is obviously a new variable in this equation. But Bitcoin is really running this morning. Let's zoom in a little bit. We are at 56,852. That is as quoted on Coinbase. This is probably delayed by a few minutes here, but we're up over $2,300 right now. And you can see the very top of the wick on this candle. At one point this morning, we were at 57,400 on Bitcoin. As people keep piling into those ETFs, and those ETFs are buying the underlying asset to offset that. And, well, there is just a lot of buying happening at Bitcoin. Also important to note is that we blew through that level at 52,000 that we had historically, or not historically, for the last couple of days. You can see the line that I drew in there. We were struggling to overtake that 52,000 level. It was like 6 days in a row that we failed to break through and close above that level. I use that term loosely because Bitcoin never closes. It trades 24/7. But we finally did break above that one in a big way yesterday, and now we are off to the races. Bitcoin pushing 57,000 this morning. Now, let's talk about this one. This is a big story here, and this says a lot about the current state of the economy. Again, we interrupt your FOMO rally to bring you bad news about the economy. Lowe's beats earnings estimates as sales fall, and the company expects revenue to slide again this year. Again, you can just disregard that whole phrasing of beats estimates because everybody beats estimates. The estimates are worthless. Sales fall. That is the key point in that headline right there. Lowe's on Tuesday beat Wall Street's quarterly earnings and revenue estimates, even as the company continued to see customers tackle fewer home projects. The home improvement chain was going up against lower expectations for its fourth quarter. It had cut its full-year forecast in November after CEO Marvin Ellison said the company felt a greater than expected pullback on pricier items and discretionary home projects. This company already reduced their expectations. All right, this is the thing. These were already lowered expectations. So let's get into some numbers here. Lowe's said it factored economic uncertainty into its forecast for the current fiscal year too. It said it expects total sales of between $84 and $85 billion, which would be a drop from the $86.38 billion in fiscal 23. It anticipates comparable sales will decline between 2 and 3% compared with the prior year, and expects earnings per share of approximately $12 to $12.30. Now, that 2 to 3% comparable sales decline, that's a big one right there. That's what they're expecting. Last week, Home Depot reported, and they're expecting a 1% sales decline. Lowe's is coming in even worse than that. Guys, remember, we're still talking about inflation. These are not inflation-adjusted numbers. With inflation still above 3.5% and possibly going higher still, well, you can just basically, they're saying sales are going to be declining not 3%, but something more like 6%, 6.5% if you add on inflation. So really bad numbers here on the forecast. But the worst number of all, you got to scroll down a little bit more. It's this number right here. Comparable sales for the fourth quarter dropped 6.2% year over year as the home improvement retailer saw weaker demand for do-it-yourself projects and poor weather in January. Don't you believe that poor weather in January, guys? We had a very warm, unseasonably warm January, at least in the Northeast here. I don't think it was weather that really made a difference on Lowe's projects there. That 6.2% decline, it's all about the housing market being frozen in place. Comparable sales for home professionals, meanwhile, that's a category that includes plumbers, electricians, and contractors, were flat year over year in the quarter. So it's mostly a decline in DIYers that we're seeing right now. The contractors are at least treading water. So maybe it's not all, it's not abandon hope, all ye who enter here. But the DIY guys are really taking a hit. Lowe's stock this morning is down 1.5%, trading at 227.62 ahead of the opening bell. Now let's talk about this one. United States durable goods orders. This just hit the tape of right before we went live. New orders for manufactured durable goods in the United States slumped 6.1% from a month earlier in January of 2024. That's more than market expectations for a 4.5% decline, and it follows a 0.3% decline in December. Now, this is the important thing. Excluding transportation, new orders decreased 0.3%. Excluding defense, new orders decreased 7.3%. So there's a couple of things that they're talking about in here, right? First of all, a 6.1% decline in new orders. Again, not adjusted for inflation, so you can subtract another 3% from that. It's actually a 9% decline in total stuff, or more like 9.5%. But what they're saying, when you exclude transportation, the decrease is only 0.3%. But when you include transportation, the decrease is 6.1%. So it's transportation equipment that's really causing this decline in durable goods. And that's either one of two things. That's either aircraft or automobiles that's doing that. I suspect it's probably automobiles. Now, there's been a lot of stories about Boeing and the 737 MAX and that door panel blowout and the issue with the rivets and all these other things going on at Boeing. But I don't know that that's necessarily translating into a reduction in orders for Boeing yet. We did see a story a few days ago that said Airbus was in talks with United Airlines to sell some of their new jets instead of 737-10s, but that wouldn't affect durable goods orders in the month of January. So I think it's probably autos that's really driving this. Another thing that I want to mention here is excluding defense, new orders decreased 7.3%. So when you subtract defense, the number gets more negative. That means defense spending is still growing. It's still in positive territory, even though there's all this back and forth going on in Congress about money for Israel, money for Ukraine. Regardless of whatever's going on in the political situation there, and not to start that unproductive discussion, but while that's going on, we're still spending more money on defense right now. You can see it here because when you strip out defense spending, the number gets more negative, which means that must be a positive that you're subtracting X defense. So still spending more money on things that go boom. Looking over, another thing that makes me think it's autos that's really driving these big numbers in the X transportation decrease in durable goods. We had this one from AutoZone today. AutoZone posts solid earnings with an EPS jumping to $28.89 in Q2. Now, AutoZone doesn't sell cars. AutoZone sells car parts. And this is kind of an inverse of the automakers' stock. When AutoZone does really good, it usually means the average car on the road is getting older. And so people are buying more parts to try to keep those clunkers driving. And so as new car sales are in decline because new cars are ridiculously overpriced thanks to inflation, what we're seeing here is people are spending more money on parts to keep those old things running. And AutoZone is reflecting that in their quarterly results that just got reported today. Here's a couple of highlights. Net sales increased by 4.6%. Gross profit margins improved by 160 basis points to 53.9%. Net income rose by 8.1%. Earnings per share up by 17.2%. A whole bunch of repurchased shares. They're open 26 new stores. Inventory is increasing. A lot of things going on at AutoZone here that shows that their business is booming. And AutoZone stock is up almost 4% ahead of the opening bell, trading at $2,880, up $109. Might be time to think about a split AutoZone when your stock is trading at almost $3,000. I just throw them out there. But AutoZone doing really well. That tells me that big decline in transportation, it's probably being driven by new car sales. Now let's talk about Macy's here. Macy's to close 150 namesake stores. Hard to get that one out. But they're going to grow their luxury brands. Snapshot of the U.S. economy right there. Closing 150 stores, laying off probably thousands of people. Nobody's shopping anymore, but the 1% still has a ton of money to spend, and so they're going to grow out their luxury brands. Everything wrong with the U.S. economy packed up into one convenient little headline there, isn't it? Quarterly profit beat forecasts. Of course they did. They always lower their forecasts, but current year guidance misses. The real estate plan to free up as much as $750 million of assets. It's all about that dirt underneath those Macy's stores, guys. That's what this story is about. Macy's said it plans to close 150 unproductive locations as the department store chain seeks to fight off a pair of activist firms seeking to buy the company. The company didn't give an estimate of the number of employees that will be impacted by the closures, which represents almost a third of the company's U.S. stores, and will happen over the next 3 years. Many of the stores are near other Macy's locations, which could allow some to transfer. Macy's also plans to add 15 new Bloomingdale's and 30 new Blue Mercury locations by 2026, an effort to accelerate growth of its higher-end brands. So they're liquidating stores. They're trying to get to that retail commercial real estate so they can sell it while they still can get anything for it, because the commercial real estate bubble is popping. That means the people working at those stores are going on the unemployment line. Now, we don't know how many layoffs are going to result from this. As they mentioned, they think they'll be transferring employees to possibly some other stores there. So we don't know how many jobs this is really going to impact. Macy's stock this morning is down 1.25%, trading at $19 pre-market. But we do know how many people at Sony are going to lose their jobs. Check this one out. Sony to lay off 900 workers from PlayStation division, or 8% of the unit's global workforce. This one just hit the tape a few minutes ago, so there's pretty much no text in the article. It's only a headline. But Sony laying off 900 workers from their gaming division, the PlayStation division. That's important, guys, again, because NVIDIA is showing growth in their gaming segment, even as video game companies are shedding headcount. Something doesn't add up here. We know what it is, thanks to Kakashi's research. But 8% of the global workforce. Guys, the layoffs are starting to pile up. The anecdata of the layoffs, day in and day out. Where is this strong jobs market? Is it under the desert? Does anybody know where that strong jobs market is? I keep hearing about all these jobs being added month after month, hundreds of thousands of jobs. When's the last time you saw an article that said Sony to hire thousands of workers for gaming division? Or let's say, well, real quick, let's touch Sony stock is up 0.5% ahead of the opening bell this morning because the market loves layoffs. Now, tell me, when's the last time you heard a story, something like Expedia adds 1,500 jobs? No, you don't hear that. We get this headline, Expedia to cut 1,500 jobs. This one just hit last night around 8:15 p.m. More anecdata, hundreds, thousands of layoffs. Expedia, let's see, what do we got? Expedia said late Monday that it expects to lay off about 1,500 employees as it works to recalibrate resources. Sucks to be one of those people getting recalibrated. Expedia said the employees affected started getting notified on Monday. I guess they get pink slips that say you've been calibrated. The online travel company, which also owns brands such as Vrbo and Hotels.com, said that it was committed to restructuring actions that resulted in the layoffs in a filing with the U.S. securities regulators. All pre-tax charges and costs associated with the restructuring are expected to be recorded this year to the tune of $800 million or to $100 million. I'm sorry, numbers were way off. To the tune of $80 to $100 million and are mostly employee severance and compensation benefit costs, the company said. So, what's going on here, guys? Another thing that we've seen a lot of in recent months was the explosion in travel, right? We heard about it all summer after years of being under house arrest because of the bat flu. And all of a sudden, everybody was set free. Congratulations, you're all free to move about the country. Now, all of a sudden, everybody was traveling in the summer. And, of course, the Taylor Swift tour and Swiftonomics, just amazing amounts of money were changing hands over Taylor Swift. Well, that's over now. And it looks like the hangover is starting to set in because Expedia is laying off 1,500 people. And another thing that kind of leapt out at me a little bit that I never really associated with Expedia before in this headline about the 1,500 jobs is Expedia, which also owns brands such as Vrbo. It's possible the short-term rental market is playing a role here in this Expedia deal with their layoffs. Pay attention, you Airbnb shareholders, you Airbnb owners, you guys who are trying to run short-term rentals out there. We know there's a reckoning coming in the STR market. I wonder if these Expedia layoffs might be reflecting of that. Expedia stock currently up 0.96% this morning because this market just loves layoffs. Also, let's talk about this one, guys. This is kind of scary. Really surprised this is not making more news. This is in Forbes. It's a few days old. Again, I really, this is flying under the radar from September. I am just tongue-tied this morning. From February 23rd, Change Healthcare cyber attack disrupts services nationwide. And here's what to know. Now, guys, I want to mention that this story happened just a couple of hours before that story last week about all the cellular networks going down. And remember, they swear that the cellular networks going down was not a cyber attack. AT&T is claiming that it has something to do with an upgrade of their equipment and how that would make Verizon networks go down and how that would make Cricket go down. I don't know how an upgrade at AT&T somehow makes Cricket and Verizon drop. But right around the same time the cell phones weren't working, this was happening. A cybersecurity attack at Change Healthcare, a subsidiary of United Health Group, that began Wednesday, has caused prescription delays and disruptions at a number of pharmacies across the U.S. and is ongoing Friday. Again, this is a few-day-old story. I believe this is now behind us. United Health said in a filing that a suspected nation-state associated cybersecurity threat actor, that's a nice way of saying either the Russians, the Chinese, or the North Koreans hacked us. They gained access to some of Change Healthcare's information technology systems on Wednesday. The company said it proactively isolated the impacted systems from other connecting systems immediately after detecting the threat. In United Health's latest update on Friday morning, it said it believes the issue is specific to Change Healthcare. All other systems across United Health were operational. CVS told Forbes the attack was impacting certain CVS Health business operations. There's no indication that CVS Health systems had been compromised. Walgreens said in a statement that the vast majority of prescriptions weren't impacted, and that for a small percentage that may be affected, there are procedures in place to fill prescriptions. Footnote, I really hate when corporate people and politicians use the phrase vast majority or the overwhelming majority. Whenever they say things like that, it's almost always not the truth. That, oh, the vast majority of the houses didn't burn down last night. No, it usually means the house burned down last night. Publix and GoodRx both flagged pharmacy disruptions on social media, along with at least one pharmacy in Colorado and California. In response to the attack, the American Hospital Association advised healthcare organizations that were disrupted or potentially exposed to disconnect from United's network until it deems safe to reconnect. So a lot going on with that one. Again, I apologize for being so late on that story. It's a couple of days old. Really surprised that didn't get more coverage. And I just want to say thank you very much to Mr. Cole Marsh for the super sticker. Thank you, sir. I appreciate that. The stickers don't show up on StreamYard, but I appreciate the support of the channel nonetheless. Thank you, sir. And thank you, Andrew the Great, otherwise known as Andrew the Modest, Andrew the Humble. Thank you, Andrew. I appreciate the super chat very much. He says, good morning, Melonhead. Say hi to Mish the Mod for me. You got it, brother. Thank you, Andrew the Great. I think you are awesome, sir. You are a magnanimous Melonhead, very much so. Thank you for supporting the channel. Oh, thank you, M&J, who gifted 5 memberships also. And, well, guys, if you were gifted a membership from M&J, be sure to say thank you in the comments. That was very nice of you, M&J. I appreciate that. And while we're on the subject, thank you to all my channel members, which now includes Miss, I'm going to try to say this right, Kersha Kivitz. Did I get it right? Thank you, Kersha, and welcome, new channel member. I appreciate that very much. KDM says, regarding car parts, there was a line of 30 to get in the U-pull. Oh, let me say it again. Sorry, I messed it up. Regarding car parts, there was a line of 30 to get into the U-Pull-It salvage yard on Sunday afternoon. Never seen it like that. So, wow, we're raiding junkyards now to keep these clunkers running because new cars are unaffordable. What's the average new car in the United States now? It's got to be close to like around $40,000. And we're talking like baseline models here. These things are getting so freaking expensive. And why? They just keep putting more electronics and more programmable crap in there. I don't need my car to say, I'm afraid I can't do that, Dave. I need my car to start when I turn the freaking key and get me where I'm going. And if it's cold out, I need the heat to work. That's all I really ask for in a car. I'm a simple guy. They keep piling all this crap into cars, making them more expensive, making them harder to service. And what are they? They're not improving lives when they're doing it. They're just making them worse because now we need to indenture ourselves just to freaking afford one of these things. And now we're all in junkyards trying to keep the old ones running. Thank you for that anecdote, KDM. That's a big one. And I apologize for the rant there, guys. But, you know, car makers, keep it simple, guys. How about a simple car for simple people? Just an idea. This car can repossess itself if you don't make payments. Well, why am I going to pay extra for that? I don't know. Thank you, Nashville Pasta Man, also, who says Sony beat estimates and then beat the snot out of their employees, but only 1,000 of them. That is a very melonhead appraisal of the situation, Pasta Man. Fixed it for you. I'm not going to bet it. I'm not going to bet a job at a newspaper writing headlines as soon as I can find one still open. Yeah, that is a much more accurate headline. Sony beats estimates and then beats the snot out of their employees by only 1,000 of them. Thank you, Nashville Pasta Man. I appreciate the super chat and the laugh this morning and the support of the channel, sir. And Steve Whitus says, we will be told we are in a recession when the government runs out of ways to hide it. Are they going to define their way out of that recession again? I don't know. Look, I do believe GDP is going up. All right. And GDP going up pretty much means we're not in a recession. Now, the problem is the G in the equation, right? I don't remember the equation off the top of my head, what the letters were, but you basically have private sector investment, consumption, government spending, and I forget what the other one was. But the government spending has really been driving a lot of this growth in GDP. And even some of the non-government spending, a lot of the construction spending that we've been seeing that looks like business investment in the GDP math, that's subsidies provided by the Inflation Reduction Act or the CHIPS Act for things like electric vehicle factories that right now are not making more electric vehicles. They're not producing any value for the economy because people don't want electric vehicles. So we're not getting efficient allocation of capital. And so the second the government stops subsidizing the hell out of everything, this economy is going to crater because these investments are non-productive. Take away the government spending, take away the frivolous incentives and subsidies, and the electric vehicle industry collapses under its own dead weight because the market just doesn't want it. Now, from my discussions with my buddy Tommy over at Car Concierge Plus, shout out to Tommy, the market is going bonkers for hybrids still. They really love hybrid cars. And yet you don't hear about hybrids in any of the headlines and any of the talking points from the executives and the CEO. Why are they not talking about the models that people want? Why are they talking about the models that the freaking politicians want? Because all these executives have their hands out. Please, sir, may I have some more? To the government, trying to get another subsidy for a factory to build cars nobody wants. Market wants hybrids. Build hybrids. Subsidize hybrids. If you must subsidize something, you don't have to, but if you must, subsidize hybrids. They don't do that. They subsidize EVs. It's more about politics than anything else. Anyways, that's when the recession hits, when the government runs out of ways to hide it, or when the government decides to just stop subsidizing economic growth. But trying to government spend your way into economic expansion is like trying to stand in a bucket and pick yourself up by the handle. It sounds great, but physics just doesn't work that way. It just doesn't. Anyways, guys, I want to say thank you very much to everybody for the generosity this morning, for the super chats. Thank you to all my channel members and magnanimous melonheads for everything you guys do for the channel, as well as all of you folks on Patreon. Thank you guys for all the support. I really appreciate it. Something coming out later today that's kind of got me freaking out right now. I'm not going to lie. That's why I'm a little tongue-tied right now. More to come on this channel. Keep your eyes peeled, guys. This one might be big. Thank you, everybody. Hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.